Automakers on track for their best year since 2007. Let's talk to Anthony Curry of Reuters Breaking Views. Anthony, very quickly, December sales, Chrysler, Ford, and GM up 10%, up nearly 2%, up 5%, respectively. Good numbers there.
Not bad. I mean, don't forget, December was still impacted a bit by Hurricane Sandy and other things following on, and consumer confidence getting a bit dented by what was going on with the fiscal cliff. But no, I think overall, not bad numbers. I think we'll see some of the Japanese automakers doing better. But don't forget, 2011, they had the tsunami and the earthquake and everything else, and also there was some Thai flooding. So they're sort of coming back to strength again last year. But no, overall, not bad. And I think it brings sales into 14.5 million for the year for the industry in the US or North America, which is pretty good. Right, so can't grumble at that.
And looking good for 2013 as well. All right, you've got a very interesting piece today comparing the banking industry with the auto industry, saying that the banks could really learn something from the auto industry, of course, both getting those big bailouts back in 2008. The Motor City, quote, cranking out cash, as you put it, but the bulge bracket banks eking out fairly minimal returns.
Yeah, exactly. So we're looking at a couple of different metrics here, so it might seem a little bit off, but think about it. Both of them went to the government or had the government come to them in 2008 and said, look, we're in trouble, we need cash. Right. So both of them got helped, and GM and Chrysler especially was seen as the basket cases, whereas the banks, I even remember writing this saying the banks probably deserve a bailout more than the GM and Chrysler do, because they've been dysfunctional for years. But fast forward 4.5, 5 years, what have we got? We've got the car companies have said, okay, we've been forced to do this to some extent, but Ford's done it off its own back. They've managed to get rid of all of their overheads, which made them so unprofitable until they got up to about 15, 16 million cars sales a year industry-wide. So they're now profitable at around about 10, 11 million sales per year industry-wide. Look at the banks. They're doing okay. If you look at their absolute numbers, revenue's kind of okay. Profits at least look big on an absolute number. Right. But if you look at their returns, they've got so much more capital behind the business now that they're eking out, I think Goldman's at 8.5% return on equity forecast for 2012, which is below its cost of capital, which means that's why partly the reason why it trades below book value, right? So whereas the car companies, they're getting cash out there, the GM's managing to pay back Treasury. Now, of course, their shares aren't doing brilliantly compared to where they were, but that's more of an environmental issue that everyone's been suffering from over the past couple of years.
Definitely. Well, you have got two takeaways, though. One, strategic decision-making, and quickly, which you've alluded to, and compensation, how out of whack it is in the banking industry.
Yeah, if you look, again, the car companies took a long time to come to this, but they shed brands all over the place. They shut down lots of dealerships, which help get the cost down. What can Wall Street do? Well, it's pay and people. So do they need to cut people? Do they need to cut pay? Arguably both. The environment's been so bad for so long. But if Goldman Sachs, for example, were to cut its pay by about a quarter, they'd still be paying out about a third of their revenue to their employees. And that would boost last year's expected return on equity up to about 12.5%, which means they're actually churning out decent profits for their shareholders again. Right. And yet on pay, look at Alan Mulally as CEO and his executive chairman, Bill Ford. Between them, they made about about half a percentage point of net earnings for 2011. Right. If you apply that to Blankfein, his pay would double to 24 million for that year. If you apply it to Jamie Dimon, his pay would double to 100 million. Now, no bank is going to be paying that out anytime soon. Right. But the fact that Ford can do that and get away with it and not get criticized is an example of just how well they've actually managed to restructure their business, get it profitable, and be able to pay their top guys top whack when they deserve it.
Interesting points. All right, let's move on. Of course, fiscal cliff, all the talk. Another piece coming out of Reuters today about how to sort of play the fiscal cliff. For instance, payroll tax that could affect those at lower income levels who might shop at discount retailers like Target, TJ Maxx, or Ross stores. The story saying maybe you want to get out of those stocks. Conversely, or despite that, with income tax not on those families under $450,000, the consumer staples such as P&G, Coke, and Walmart could be holding steady. What do you think?
Well, it's not a bad thing. Actually, the best thing about it is that people are starting to differentiate, which they've been trying to do ever since the crisis hit in 2007. I think to actually be able to go through this and say there are fundamental reasons why XYZ stocks or ABC stocks should do well or bad is a good thing. And actually, we looked at this in a sort of more macro environment and said, okay, well, let's look at the internal correlation on the S&P 500 between stocks. It was at 60% during the crisis. And what that basically means is no matter what the fundamentals are, a lot of stocks are going to move one way or the other in tandem. Say there's a financial crisis, there is the fiscal cliff issue, there's Europe, there's Greece, whatever it is. They're all going to go one way or the other, regardless of what fundamentals are. Well, that's now come down to about 35, 40%. as of the end of last year. So that means that actually there is more room for stock picking, and that fundamental analysis might actually have some value. And on the fiscal cliff stuff, sure, that's where it should really impact first, right? But of course, the one worry is that with these politicians being so absolutely useless at getting anything done.
How do you really feel?
Oh, well, yeah, I'm a little bit on the fence. But who knows? I mean, it could well be that in 2 months' time when this comes back up again, it all goes to hell in a handbasket. The debt ceiling gets screwed up. Fiscal cliff comes back to bite us again, if cliffs can bite, if I can mix metaphors. And it just looks a complete mess again, potentially. So maybe that screws it up again. But at the moment, it looks as if it's somewhat better and easier to pick stocks based on fundamentals than it has been for 3 or 4 years.
So let's hope we didn't just kick the can down the road and we're going to have a whole
Well, I almost brought one with me, but you know.
All right.
Bit of visual.
Next time. All right. Anthony Correa, thank you so much. I'm going to move now and talk to Jerome Martis, who's our Director of Consumer Research. We're going to talk some Gap and some retail here, because this is a really interesting story. They're purchasing Intermix, which is a high-end luxury store. We've got a few here in Manhattan, Madison Avenue, Fifth Avenue, $130 million going into the luxury retail mode here.
Well, Lisa, last year Gap already introduced, they collaborated with other high-end designers like DVF and also GQ designers, and it actually went very well for the Gap. Gap is a company that has pretty much been in a turnaround mode for over a decade. In terms of same-store sales and earnings, it's been stagnant, the stock has been stagnant, and they finally got their groove back. So it's the right timing. The company is in a growing stage right now. Over the last 6 months, they posted very impressive same-store sales, and even last November, they saw a jump in earnings of 66%. So it's the right time to do this right now.
Wow, share buybacks now, right, for the company?
Which reinforces the strength, the financial strength of the Gap right now. Last year, they introduced colored jeans. Old Navy was a big hit for back to school. DVF was a big seller, and the Matte Men collection of Banana Republic just flew off the shelves. So it's the right time to buy Intermix and align themselves together.
So basically, they fell out of fashion literally, in that the designs just weren't there. And I know, as you mentioned, color jeans were a part of that, but they've gotten their groove back in terms of what the consumer is demanding and wanting out there.
Correct. So right now, the company is at a growing stage, and that's why the alignment, the collaboration with Intermix, the purchase is right for the timing.
All right. Gap trendy again. Stock's up 1.5% today. Jerome, thank you so much. Looking fashionable as always yourself. All right, folks. Remember, follow us on Twitter at Reuters Insider. Check out our YouTube channel, Reuters.com/ReutersTV. I'm Lisa Bernhard. This is Reuters.